At some point, his view is maybe a tariff is better than a deal. Michigan's governor has directly raised the alarm with President Donald Trump after the damage his tariffs will do to the auto sector in America's car capital. In Michigan, the heart of America's auto industry, the pressure is building. Over the summer, President Donald Trump's latest tariff measures have landed with force, and the numbers tell a sobering story. General Motors reported its second quarter profits fell by $1 billion, attributing much of the decline to new import taxes. Stellantis said it lost $2.7 billion in the first half of 2025, also pointing to tariffs as a major factor. Ford's latest results are expected soon, but analysts already anticipate the same pattern. Trump has pitched these tariffs as a way to bring manufacturing back to the United States. Yet in Detroit and across Michigan, the early impact is hard to miss. Rising costs, squeezed margins, and a growing unease that these measures may be hitting home harder than they are hitting foreign competitors. The new import taxes rolled out in the last several months could lead to more factory floor job losses, price hikes, and lower profits. The problem starts with the basics of production. Since June 2025, imported steel and aluminium, critical for vehicle frames, chassis, and countless components, have carried a 50% tariff. Canada, the largest aluminium supplier to the United States, is now facing a 35% rate on non-USMCA goods as of August 1st Street. Mexico, though given a 90-day delay on new tariffs, still faces the threat of 50% duties on certain metals and auto parts if talks fail. Outside North America, India's rate has been raised to 50%, affecting some automotive parts and materials that US manufacturers rely on. Even items far from the assembly line, leather, textiles, and interior trim imported from Asia are caught in the net. The complexity of modern supply chains means that a car labeled "Made in America" can still depend on dozens of foreign-sourced elements. Many US-based suppliers themselves import critical subcomponents, now taxed heavily before they ever reach a Michigan factory floor. So far, auto companies have been eating the impacts of the tariffs, and that's what we're seeing in the latest profit reports. It's only a matter of time until the companies pass those costs off onto the customer. At first, the Big Three absorbed these new costs, hoping to protect sales. But according to the Center for Automotive Research, the 25% tariffs on autos and parts alone could add $108 billion to industry costs in 2025. That figure doesn't even account for the knock-on effects from 50% steel and aluminium duties, or the layered tariffs from multiple trading partners. The Alliance for Automotive Innovation warns that these costs will inevitably reach consumers. Higher sticker prices could push entry-level models off the market entirely, reducing choice and slowing the rollout of new technologies. Electric vehicle makers face an extra hurdle. The US still lacks a large-scale domestic battery manufacturer, forcing reliance on imports that now carry steep tariffs. In Detroit, cutting production means more than fewer cars on the lot. It means fewer jobs, especially in communities that have spent decades rebuilding after past downturns. Analysts say the next 3 years could bring sustained declines in sales and employment if current policies stay in place. Trump sees tariffs as leverage to pressure trading partners into investing in the US and opening their markets. Canada's Prime Minister Mark Carney, however, has stayed firm, keeping most Canadian exports tariff-free under USMCA, and seeking new trade routes abroad. He maintains that the steep duties on Canadian metals and parts ultimately raise costs for US consumers and manufacturers more than for Canada. It's a test of two strategies. Trump's high-pressure push for quick concessions versus Carney's long-term approach built on stability and alliances. For America's auto sector, the outcome will shape whether these policies deliver stronger domestic production or deepen the cost and job losses already taking hold in Michigan and beyond. Canada has been very tough to deal with over the years. We don't need them to make our cars, and they make a lot of them. We don't need their lumber because we have our own forests, etc. We don't need their oil and gas. We have more than anybody. I'm being honest, like no one knows what he wants, including elected officials down here. In early August, Donald Trump escalated his tariff campaign. Canada was locked into a 35% duty for non-USMCA goods, while the EU, Japan, and South Korea accepted lower tariff caps in exchange for concessions. Switzerland was hit with 39% after talks failed, and Mexico secured a 90-day delay. But this isn't just about one country. Ottawa is under sustained pressure, and Beijing is advancing strategies that undercut US leverage. Trump's tariffs have opened multiple fronts, and both Canada and China are responding in ways designed to outlast short-term shocks. For a long time, Canada was happy to send its oil to the US. Nearly all of Canada's oil is exported to its neighbor. It seems not very exposed because it's the one thing the US hasn't really put any tariffs on so far. I think they recognize they need our oil and gas to provide energy security for their country. Under Prime Minister Mark Carney, Canada has refused to rush into a bad deal. Instead, it is reinforcing links with Mexico, diversifying export destinations, and protecting domestic industries from sudden disruption. One of its strongest cards is energy. The United States depends on millions of barrels of Canadian oil and gas each day for energy security. Imposing tariffs on that flow would raise US consumer prices, a cost Washington is unlikely to risk. This interdependence allows Canada to absorb tariff pressure while building alternative markets rather than bending to Washington's timeline. The impression we get certainly is that Trump's leverage with China is much less. Well, China is reportedly tightening its grip on critical minerals it supplies to Western defense companies. According to a Wall Street Journal report, Beijing's control over rare earths is delaying production and driving up the cost of key materials used to make weapons, jets, and drones. Beijing's pushback is targeting the very supply chains that US tariffs cannot reach. On the industrial side, China controls roughly 60 to 70% of global rare earth mining, and close to 90% of refining. Since late 2024, it has tightened export rules for minerals essential to defense manufacturing. From high-temperature magnets for jet engines to specialty alloys, making these materials harder and more expensive for US contractors to source. China has pulled off something of a magic trick when it comes to oil independence. It's estimated more than a fifth of China's oil imports last year was sanctioned oil. On the energy front, China has been dismantling one of its biggest vulnerabilities, reliance on seaborne oil imports that pass through the US-monitored Malacca Strait. By expanding renewable power generation, building the world's largest electric vehicle industry, and adding to its strategic oil reserves, Beijing is reducing the leverage that US naval power once held. It has also turned sanctioned oil into a tool of resilience. In 2024, China brought in about 821,000 barrels per day from Russia, 1.44 million from Iran, and roughly 268,000 from Venezuela, all under US sanctions. Much of this crude is processed by smaller teapot refineries, which then sell refined products across Asia. This approach keeps feedstock costs low, supports domestic refining capacity, and weakens the intended bite of US sanctions. Together, these moves give China more room to maneuver in a trade confrontation, restricting what America needs while securing what China itself cannot afford to lose. Trump's intent is clear. Make resisting US terms more expensive than conceding. Yet, both Canada and China are using asymmetric responses. Canada leans on its role as a critical energy supplier. China makes essential inputs scarcer and cuts its exposure to American pressure points. Neither is matching tariff for tariff. Both are targeting US vulnerabilities that tariffs cannot fix. The result, rising costs inside the United States, from defense materials to industrial components, with no quick resolution in sight. Trump is chasing rapid, visible wins, agreements he can showcase as proof of American strength. Carney's approach is defensive patience, maintain negotiating channels, protect Canada's structural advantages, and avoid locking in concessions that could collapse within months. Xi Jinping's strategy is slower still, reshaping industries and supply chains to make the next trade conflict less damaging for China. This contest is no longer about headline tariff rates. It is about which side can endure and adapt under pressure. Canada's energy leverage and trade diversification, China's control over critical minerals and its energy transition are all designed to make US economic coercion costlier over time. Trump's tariffs have reshaped the tone of global trade. But they have also triggered a coordinated pushback that will test America's ability to fight on multiple fronts without giving ground. We can give ourselves far more than anyone can take away. We're building this great country. I just met with the Premier building BC, building Canada, building in a Canadian way, building sustainably, building together, building positively, and that's what we're going to do. And yes, we will come to something with the Americans, something constructive with the Americans. On August 1, President Trump raised tariffs on Canadian goods not covered by USMCA from 25% to 35%. It was a clear escalation, intended to pressure Ottawa into a trade deal. But Canada didn't hit back with equal firepower. Instead, Prime Minister Mark Carney turned attention inward toward building economic strength from within. And we can do so through our leadership in clean energy, in critical minerals, and in the intelligence infrastructure of the AI revolution. Rather than matching Trump's aggression, Carney emphasized long-term strategy. He doubled down on Canada's potential as a clean energy and critical minerals leader. While others debated retaliation, Carney introduced a fast-track framework to accelerate mining approvals, signaling that Canada's response would be structural, not reactive. Canada is home to some of the largest reserves of critical minerals in the world. We have lithium, nickel, cobalt, copper, and rare earth elements. They're all widely available here. That response may prove more powerful than any tariff. Canada holds large reserves of lithium, cobalt, nickel, copper, and rare earth elements. Minerals essential to electric vehicles, AI systems, defense, and energy storage. As of 2023, Canada's mineral production exceeded 70 billion Canadian dollars. But most critical minerals are still underground or underdeveloped. Only half of current mines are Canadian-owned, and less than a third of refineries operate domestically. This imbalance is what Carney's government is now racing to correct. With the global demand for rare earth magnets expected to more than double by 2035, Canada is positioning itself not just as a raw exporter, but as a complete supply chain partner. This is more than a mineral boom. It's a bargaining chip, especially as the US struggles to secure alternative sources. I'd like to buy minerals on Russian land too if we can. The rare earth. They have very good rare earth also. They both do. While Trump pressures Canada, his administration is simultaneously casting a wider net. In recent weeks, Trump floated the idea of buying rare earth minerals from Russia, even suggesting the possibility of using deals to justify sanctions relief. At the same time, tensions with China remain unresolved. After Trump's second-term tariffs hit 145% in April, China retaliated by restricting exports of heavy rare earths, materials used in US defense and technology. Tesla and Ford saw disruptions. Suzuki halted production. In that context, Canada stands out. It's a stable democratic neighbor with abundant resources, but now also burdened by US tariffs. The contradiction is hard to ignore. Washington needs what Ottawa has, but seems unwilling to admit it. Carney's strategy is clear. Use the pressure not to cave, but to transform. Bill C-5, known as the One Canadian Economy Act, aims to reduce regulatory delays that often stall mining projects for over a decade. It also sets the groundwork for refining capabilities within Canada, a step that would reduce dependence on Chinese processing. Company like Electrovaya is already showing what's possible. Electrovaya exports high-performance lithium-ion batteries to Japan and the US. This early example could become the template for a re-industrialized mineral-powered Canadian economy. Trump's tariff-first strategy seeks quick political wins, but the risks of alienating Canada are growing. If the US loses access to Canadian minerals, it risks bottlenecks in EV production, AI hardware, and even military supply chains. The Department of Defense has already invested over $500 million in domestic rare earth supply initiatives, including a $400 million package for MP materials just to reduce dependence on China. But these efforts will take years. In the meantime, Canada remains America's most viable near-term partner. And Carney knows it. By refusing to retaliate impulsively, he's repositioning Canada as a mineral power, not just for domestic growth, but for strategic leverage. Because in the long run, you don't win a trade war by shouting louder. You win it by becoming indispensable.